Now we're going to talk China. We did say we were going to do a bit of a world tour here. We're talking about ICBC, or as it's known by its longer name, the Industrial and Commercial Bank of China. It is the largest, both by market cap and a number of other metrics. Headquartered in Beijing, listed all over the place, but principally in Hong Kong. That's probably the share price we're going to see. Remember, these are the guys that own 20% of Standard Bank here in South Africa. Market capitalization, Hong Kong dollars, 1.87 trillion. So if your head's spinning now, that can be translated into about 240 billion US dollars. Because remember, the Hong Kong dollar is pegged to the US dollar. So there we go. A little bit smaller than Bank of America, but pretty enormous. Price to earnings ratio 5.4. We're going to explore for a moment why that's so low, and dividend yield 5.5%. Just an overview of the business model.
Yeah, so I think just an interesting sort of fact on the size of the banks is that when you look at, there's a very interesting sort of publication in the UK called the Banking Magazine. And they've estimated ICBC's brand value to now have surpassed that of Wells Fargo. So. You know, it's very opinionated, but we'll...
Because of course they're a mega player in the Chinese and Asian markets, but they also are a global player with aspirations to be everywhere, and they've started opening branches in every corner of the world.
That's right. You know, so it's like you say, they've got sort of a footprint that's evolving and growing everywhere. Due to sort of the whole issue around money laundering scandals that's come out of Chinese banks and the whole stock market sort of problems that we've been seeing in China, it has not been sort of a great investment.
Let's look at the chart. Sorry, it did come up there, and you can see you're exactly right. Over 5 years, it's sort of drifted around. I think its all-time high was about 7 Hong Kong dollars, and now it's at 5, so it's a little bit nowhere. So we're going to be a bit short of time here, but I just want to make another general point. This company is 70% held by the Chinese government, as are some of the other big Chinese banks like Bank of China and the agricultural banks. So there's your problem right away. The other thing is they do a lot of lending to government agencies. And in China, it's considered very bad to call out a loan and say, listen, you people are insolvent. So it's all this extend and pretend, they call it. So they have lent money to some regional development association in a province of China, and they can't pay. So they say, well, look, we'll just convert this thing to a longer term loan and you can get... So that's the concern, is that there's a high debt to GDP ratio, and that there's a lot of kind of nudge, nudge, wink, wink going on, and that some of the loans aren't actually as high quality as they suggest.
No, I agree. I think, you know, that's the fundamental reasons for this probably not being the greatest opportunity. But when you look at what the favors sort of have moved back into investing in China now, this last week, for some reason. So we'll see how that plays out.
Because I am fundamentally bullish about China and about the effort that's being put in there. And the new Chinese banking regulator, Mr. Guo, who was quoted in some of the newspapers in the recent days, seems to be trying to get the banks to do less of the extend and pretend, be more circumspect about their lending. And there's a massive opportunity, and it's a thriving economy that's still growing at 5-6%, so why are we worried? But
trading, probably manipulated in China still when you look at the market, and then also at the bank. When you look at the bank, all these issues that, you know, we can't pinpoint straight away.
Yes. Okay, so we're going to go, what not hot on that?
I'm not going to be hot on this.
Interesting long-term story though, one to watch. Okay.